So UBS, there's room for gold to run higher. Here's an excerpt. We upgrade our gold forecast materially. We shift our price targets to the previous published upside scenario. Now looking for gold to rally to 3,500 this year.
Welcome to this morning's Markets and Metals with Vince Lanci, where each morning he brings you the precious metals news to get you ready for your day. Now, here's Vince.
Good morning. I'm Vince Lanci. This is the Gold Fix Market Rundown. Today we'll be discussing UBS. They have a report out as of April 11th, claiming that they believe there's room for gold to run higher. We'll explore that a little bit. We're also going to discuss the upside risks to demand, meaning further upside, as alluded to in the report, focusing on China. And what are the signs of this ending? And we're seeing a couple of them now. Before we move on, though, however, we do want to say there's no founders discussion this Sunday. We will be on holiday Monday. And more importantly, happy Easter and Hag Sameach to everyone out there. Let's start with the markets. 10-year yields are 433, up 5. Most of these markets are closed, by the way. Okay, so if there's a dot or a snowflake next to my market, that means it's not open. So I'll just say last. 10-year yields are last 433 and change. The dollar is 99.33, actually active. The S&P 500 last 52.96. The VIX 29.66 last. Gold is open at the spot market 33.27 and change, down 15. Silver is 32.54, essentially unchanged. Copper is 4.67. Up almost 3 cents. WTI 64.26, up $1.77. WTI definitely off its lows and percolating along with copper. If you're a silver person, that's the sun and moon and stars lining up. As long as gold holds its own and those two keep rallying, you're going to see someone go, oh shit, let's buy some silver. And then that physical demand we talked about will start to manifest in the futures. Moving on. Natural gas 325, down 1. Bitcoin 84 spot 500, down 300 and change. Palladium 959, platinum 967. Soy, corn, and wheat down, and up very marginally, 1033, 479, and 560. Okay, there's the front page. The mechanics of yesterday's panic into gold. You know, there's another story out there that's worth mentioning. When we talk about panic, and by the way, it's worth mentioning because it's right. When we talk about panic, we're talking about the mechanics of it. Okay, this is why gold rallied. It rallied because Asia bought, and then Europe bought, even though they don't usually buy into Asia's buying. They usually kind of observe it, and then the U.S. decides if we're going to take it higher or if we're going to smack it down, or usually right around the gold fix time in London. So that's the mechanics of the panic. And some of the research that we're reading or getting a glimpse of is also showing that in a quantified way. And the analysis and comments that we've been getting or seeing, anecdotally from executives have been, oh shit, we're going to have to buy more gold, aren't we? Now, there's another story that's running parallel to this, and it is also true. While there is genuine panic and the mechanics of it are seen, they're not just talking about it. There's also another side to this, and that will be the WEF types. That would be the Europe Forever types, and they're pushing back on Trump's tariffs any way they can. And one of the ways they're saying it is by, editorials openly questioning is the Treasury safe anymore? Of course the Treasury is safe, okay? But you have to have a little gold if you're going to own some Treasuries as well. So they're just negotiating with Trump using PR. And to the extent that the continent and I don't know what globalist, I guess is the word to use in the UK, clinging on to life over there, want to negotiate with Trump using propaganda. Well, that's the way to do it. So the panic is real, okay? But as you know, our friend, close friend, Tom Luongo, says, yeah, Europe's just talking out their ass, uh, trying to make it look like trying to talk the gold. I'm not the gold, trying to talk the treasury market down. So that's all true, and it's crazy, but that's what they're doing. But anyway, all right, moving on. To yesterday featured UBS's room for gold to run higher. We're going to discuss that. The mechanics suggest that we already went through that. Exclusive. We put this back up here. It's 2 days old, right? But it seems like a lifetime ago. 4 days old. Why China's insurance pilot plan is really a mandate. That's our opinion. It's from our last Sunday discussion, and we really think it's worth paying attention to, especially since we were digesting and processing information from friend of Goldfix, Bai Zhaojun, who's on the in mainland China. Every stablecoin is financial fartcraft, demand for U.S. Treasury bills. That Michael's been writing very well of late, and that's not his title. That's our title, quoting him. Uh, it's true, though. I mean, you're going to use treasuries to stake, to use tether or whatever. You get the point, right? And then there you go. There's the rest of them. Let's go. Let's start. So UBS, there's room for gold to run higher. Here's an excerpt. We upgrade our gold forecast materially. We shift our price targets to the previous published upside scenario, now looking for gold to rally to 3,500 this year. The case for adding gold allocations has become more compelling than ever in this environment of escalating tariff uncertainty, weaker growth, higher inflation, and lingering geopolitical risks. The current backdrop, wherein global trade, economic, and geopolitical relationships may be changing, reinforces the need to diversify into safer havens like gold. We expect gold's rally to extend into next year and for prices to stabilize at higher levels further out. And there's their gold year-end targets. Before we move on to the next section of that we want to talk about the China demand. UBS is notoriously conservative, and as bullion banks go, their history, at least speaking to my own personal history with them, they were not the enemy starting in 2006. Before that, they were the enemy. By that, I mean a bullion bank that doesn't care about suppressing the market. Look, their client base is pensions. Their client base is the wealthiest of the wealthy in Europe and in Asia and used to be in the US, right? All those people demand preservation of capital and they demand responsible, what's the word? Custodianship. So UBS has been lagging in their target raises compared to their more aggressive brethren. Uh, this is an aggressive move by them, and it warranted an explanation, in my opinion. And I think we got it. You may say that this could be near the top based on the fact that they're going over the top, but their reasons are legitimate. We're only higher now because of that report. I mean, not only higher, but look, this report came out April 11th, and that means it was known about April 9th. And that means people went, oh shit, UBS is right, and bought it. So this report, I think, had a material effect on the market. Okay, next section. We update our upside risks in deference to the China demand. Now, an important development to monitor is the rollout of insurance companies' gold mandate. Among those that have been allowed to invest up to 1% of assets under management in gold, a few have now started doing test trades. And I'm quoting the report, I think, here. I didn't put quotes on it yet. This is earlier than we expected. The 10 insurance companies that have so far been allowed to invest in gold account for about 57% of the industry. All right. We went through this in detail, giving you our interpretation of words like allowed to invest and test trades and 1% being capped, the cap being raised. We really, if you're interested in more detail about this, we have it what do you call it, hyperlinked in there. We believe the market has begun discounting the additional purchasing coming online, as well as the pilot insurers not being as patient as most think. So there you go. Next, now they didn't mention this, but we're gonna throw it in there. To add a new wrinkle not discussed anywhere else yet, but will be soon, the BRICS Summit is upcoming in July, right after Basel III's final rollout begins. Basel III on July 1st, and the BRICS, I think, is 6th to the 8th or 4th to the 6th. No, it's after the 4th, right? So it's going to be 6th to the 8th. So as insane as it is, the market may be lower over the next few weeks, but it could be at or above these highs as the July 1st Basel III rollout begins and the BRICS 2025 summit closes in. That continues at the bottom, that analysis, that breakdown of the Chinese demand, a little bit more meat on that. That continues at the bottom in premium. Also in the premium post entitled UBS, there's room for gold to run higher, with a special voice note introduction to give you some framing on how to read this report. Next, markets recap. The S&P 500 ended higher as investors weighed progress in U.S. trade negotiations with Japan and the EU. Treasury yields ticked higher amid market calm. Gold prices slipped on profit booking, while the dollar was little changed. Oil climbed on trade deal optimism and fresh Iran sanctions. Energy stocks led Canada's main stock index higher as investors took stock of U.S.-Japan trade negotiations, although sentiment remained fragile amid tariff uncertainties. Toronto Stock Exchange Composite Index ended 36 basis points higher. All right, so the summary is if you want to call it a summary, is gold sitting just under all-time highs once again. The global head of UBS's gold precious metals area just came back from a trip to China, and the report that they put out is materially valid in discussing gold's potential for a bigger rally. Material enough that people bought it when the report came out. There are several areas in it. It's not a very lengthy report. It's a well-written, well-worded report, and it tells it like it is. There's the risk to the upside. There's liquidity problems on the upside. There's a growing ETF demand out of China. It's not significant yet, but it's quadrupled in the last year, I think. The ETF demand in the US is also growing. They're also plugging into something that we had said about if ETF demand returns to COVID or the war, it's going to add significant upside to the market. They describe it in tons. We describe it in price. That's 3,600. That's our price on that. But that's it. Let's do a final market check talking about something. I'm looking for tops here, right? Here's where I throw water on everything, right? All right. The reasons to think this is a top, there are two reasons. One, because you're thinking about risk, and another because you're not long. So you're going to start hearing people talk about this is the top. I think we're going to have a sell-off. And you know what? There are two schools of people doing that. One is a person thinking about risk, pausing to reassess before the next move. And the other is someone who's not long and wants it to go back down so they can buy it. So those are closet bears. That's what I would call them. But let's give some real thought to this. One of the things that gold did, Jesse had mentioned a while ago, that I plugged into. Gold starts to make new highs against currencies, from my analysis, starting in the BRICS. So it kind of like spirals out from China to Australian dollar, kind of like makes a spiral. I drew a circle spiraling out from China, kind of emanating from the epicenter of the earthquake. And then it ends up getting to the US and then Europe. And then that's when it dissipates. Well, there are signs of it dissipating now, and I'm going to give them to you. Top right-hand side is gold in US dollars. Top left-hand side is gold in euros. Lower left-hand side is gold in the yen, and lower right-hand side is gold in the Swiss franc. Now, if the BRICS currencies are the first to achieve all-time highs, then the G7 currencies are the last to achieve all-time highs. So you can make the case that this section of the run is over when X happens, meaning when all the G7 currencies have topped out. Usually the dollar is one of the last, if not the last, for it to top out against. But that's not the case this time. So here we go. Gold in dollars, new all-time high, right? Right there. The little red dot is right there, right? Gold in euros, new all-time high. Mind you, the euro just, Europe, the ECB just cut rates on the euro. They're going to do it again, and probably again. There's definitely a fear of deflationary risk between the tariffs and China's slowdown coming out of Europe. Now, the yen also just recently made a new all-time high. So gold made a recent all-time high. But then look at the Swiss franc. The Swiss franc has not seen an all-time high in gold. That means the world, at least the G7 world, has taken their money out of dollars because they're afraid of it. This is a different rotation than you usually say. Out of dollars because they're afraid of all the tariffs, right? Or the ramifications of the tariffs. And then they put their money into euros. They did. And then Europe said, well, we have to cut rates. And they said, oh, shit, we'll put our money into yen. And they did. And the yen is a safe haven currency. It's been, but the point is, when you look at the dynamic, the safe haven currencies in the world are in this order: the dollar, the yen, the Swiss franc. Okay? Forget the euro, even though I have it there. So the dollar is no longer a safe haven based on this move. The yen is not safe enough, but the Swiss franc is still safe. See that? The Swiss franc has appreciated more than gold in this run up or run out of the dollar. Therefore, if you're in Switzerland and you're running that economy, you're not happy about that, because even though it seems like a feather in your cap to be the safe haven currency of choice right now, well, in a deflationary environment with your neighbors, the euro dropping and the British pound probably dropping as well, you need a weaker currency to survive. It's a competitive debasement now. Dollar's going to zero. Everyone wants to get to zero just a little bit faster. And the Swiss franc would suffer from that. Who's going to buy the chocolate, right? Who's going to buy the watches? You get my point. The point is, they don't want their currency to be too strong. So I'm betting the Swiss are going to ease. They're going to cut. And part of the rally in gold in Swiss francs, the recent one, is because of the potentiality of a cut. Part of the UBS report is because of the reason of the potential for a cut. And when that cut happens, or if that cut happens, or whether it happens or not, when gold makes a new high in the Swiss franc, then you can say we should be careful. And that's how I'm looking at it. That's, if it continues higher. Now, there's another measure. You may recall I had this measured move, right? You may recall about a week ago, really, it was it was the 14th of March that this started. The 14th of March, when gold did this, I'm not here. When gold did this on the 14th of March, we said above here is a measured move to here. And that was our call for between 3,350 and 3,400. Now, it's not a target, it's a measured move. So depth equals distance. There you go. So here we are. I can say, again, it's not precise, but it's accurate. When it works, it happens fast, and we could be done, right? But to hedge my own "we could be done" comment, look at that wick. That's a nice long wick we got there. So maybe we are going to get a push to that price, but I won't be in it. I'm not long right now. I'm flat. I'm long GDX hedged. Let's put it that way. That said, if it does get up here, then we can have that whole silver rally that I've been talking about happening based on the physical demand in Europe. But that's another conversation. That's all for now. I'm Vince Lancy. You can read more about or listen in audio form more about everything we just discussed here in premium at the bottom of this post, or in the other multiple posts we have on these related topics on the site. Have a happy Easter, have a good Passover, and have a pleasant Friday.
Well, thank you to Vince for this morning's markets and metals, and thank you for being here with us today and all week as we have watched some really historic events taking place in the gold and silver markets. Markets closed today, as you already know, and just hope you're getting set for a wonderful holiday weekend. Or if you're not celebrating any of the holidays, that you're just getting set for a great weekend as well. And of course, if you still haven't had enough gold and silver coverage, even after everything that's happened this week, well, that's why we do have the Arcadia Economics Gold and Silver Daily. That is a daily column that I am writing now, where I keep you posted on the major things that are happening in the markets, which certainly is a handful these days. And amongst other recent notes, we did get the Silver Institute's new set of numbers out, which was in yesterday's column. And also this week, we covered how some of that metal that came from London to New York, now starting to leave. There will be more on that in today's update. And of course, also interesting to see things like even CNBC talking about how investors in the US have worried for decades that holdings of US government bonds by Chinese and Japanese investors were at risk. Who could have guessed that? Where could you have known about something like that other than at the Arcadia Economics Gold and Silver Daily, which you can find at goldandsilverdaily.substack.com, or to make it even easier, just click on the link in the description field below. And with that said, go out, have a wonderful weekend. Hope you're truly appreciating what we are getting to witness and experience and live through right now, and we will see you again on Monday.
Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.